Great. Thanks everyone for coming to this one-off IIPP seminar on a Tuesday afternoon during working hours. So very pleased with the turnout, especially as we only advertised it a week ago. So yeah, very happy that you're all here. And we're very happy to host Dirk Bessemer today. So Dirk is a Professor of Economics of International Financial Development, and he holds a PhD in economics and 2 master's degrees. And was previously a researcher at Imperial College London working on development economics issues in policy advice. He also previously worked in the UK civil service before joining the University of Groningen, where he is a professor. At Groningen, Dirk leads a research team working on financial fragility, economic models, and the causes and consequences of financial crisis. And in addition to a wealth of academic publications, he's also co-wrote OECD, World Bank, and UNCTAD policy reports. He's a frequent contributor to international and Dutch newspapers and television. In 2011 to 2013, he obtained 3 research grants, and he coordinates the economics of credit and debt research work within the New York-based Institute for New Economic Thinking, INET. Dirk is also a member of the Dutch Sustainable Finance Lab, and he's also published work with our very own Josh Ryan Collins on the interaction between the financial and real economy. And he'll be speaking to us today about his research agenda on how the financial sector may or may not contribute to sustainability. So we'll probably do about 35-minute talk and then lots of time for questions and discussion. So yeah, thanks very much, Dirk, for joining us.
Thank you so much, Lydia, for the introduction. Great to be here. Thanks for the invitation, and thank you all for coming. Fantastic, indeed, in a weekday. So some of what you read in my bio is ancient history, to do with a lot of work that I did around the financial crisis, which I need to explain to my students now. For them, it's prehistory. Was in 2007 and 8, and everything that followed raised a lot of interest in what is money, what is debt, what is the financial system, where do we go from here. And so a lot of academic research came out of that, research grants. I built up a research team, but recently I've started to build a line of research on sustainable finance. And you might say, everything's sustainable nowadays. If you don't do something sustainable, it's not going to fly anyway. But I'm hoping to convince you that there is a connection and a continuity in my line of research in asking questions about what is money, what is debt, what is it good for? And green bonds are a form of that. And what are they good for? How do they work? How does the system in which they are injected work? I'm going to attempt to, there we go. I'm going to draw on 2 projects I'm working on at the moment. One is an empirical project, a data analysis project with my research student Chris Stumfius, who's with the IMF now. And it's about green bond finance. Does it actually enable greener production? And another is with Hans Stegeman, who is the chief economist of Triodos Bank in the Netherlands. How do we rethink the finance investment sustainability nexus? And the reason to put them together is the overarching question that I'm really puzzled by, so I'm really happy to get your feedback on this. I'm puzzled by the question, in a world of abundant finance, I'm going to show data and graphs of the increase in finance, of assets and liabilities, and declining capital goods investment, how does finance relate to investment? So it's an age-old question, you might say, for economists, a very fundamental question, maybe a simple question. Yes, please. And so after elaborating this motivation a bit, I will present these 2 projects and I'll link them up before coming to a conclusion or concluding remarks at least, and hoping for your feedback on the question, how should we rethink the finance investment link given what we know about finance and investment? Yes, please. And the takeaways, just in case you're going to fall asleep after this, is that the common finance investment rationale is at odds with macro-level finance investment trends. I'm going to detail that. And in another paper we're working on, we call that financial slippage. It's as if the wheels of finance don't mesh with the wheels of commerce and production anymore, or maybe they never did. But there's a large extent to which the financial circuit moves largely independently of the real circuit. Do green bonds finance, for instance, greener production? That's an application, a specific case of that question. We don't find that in our paper. And what we take away from that is that we need to look at the system level, at the macro environment, to explain these micro findings. And we do that when we rethink the finance investment link. And I think this suggests questions in conclusions. When does financial expansion support sustainability? It's not a given that it does. So we need to understand more in what sort of, let's say, financial ecosystems this works well and where it doesn't, not where the financial slippage is very large. And what new research questions does this suggest? Some of the questions I just mentioned. Yes, please. Thank you very much. Okay, my motivation is in 3 parts. I can have the next slides. And the first is the changing finance investment narrative. For that, I go back to the time of the financial crisis when this quote, which itself is 40 years old, by a famous macroeconomist, post-Keynesian macroeconomist, some people would say, became much quoted. A lot of people quoted him to say, we are throwing more and more of our resources, including a lot of talent, into financial activities that don't really add a lot. Okay, and that was very clear, had become very clear during and after the financial crisis. Tobin saw this already in 1984 when the whole process of financialization was starting. After the financial crisis, this is a paper which was published first as a working paper in 2012 and eventually in 2015 in the Journal of Economic Growth by Arkan, Berkes and Panizza, and they found famously that the increase in economic growth, so in GDP growth, expansion of the economy, goes together with an increase in financial sector development, here measured as bank credit to the private sector, scaled by GDP. So you increase credit, you increase finance, you get more growth, but only up to a point, up to about 100%. So when the stock of bank loans is just about as big as the GDP, the annual GDP, that's when the maximum, and after that you get less economic growth. So very tellingly, their paper was titled Too Much Finance. And this was a research consensus, and for a while a policy consensus. We have too much finance. So the financial sector needed to shrink in the interest of the economy, paradoxically almost, you might say. My economy of the Netherlands is about here, 250%. The British economy is also in this region, of course. Most OECD economies, most rich countries are far above a 100% ratio of bank credit to GDP. And bank credit is only one kind of finance. There's also bonds, which I'm going to talk about now. And the bond market is much bigger than bank credit. And then there's equity, and then there's other kinds of finance, private equity, and so on. So we have this research consensus that we have too much finance for our own good, for the economy's good. It doesn't lead to productive investment, innovation, sustainability, whichever real goals you want to think about. And if I can have the next slide. Then at some point, the narrative slipped, and we found ourselves in 2021 listening to Mark Carney, who was speaking at the COP26 meeting in Glasgow in 2021, saying, up until today, this is a literal quote, up until today there was not enough money in the world to fund the transition. This is a watershed. The core message today is the money is there for the transition. So Carney was saying the opposite of what I just said. I just said we have too much finance, money and other forms of finance. He said, up until today, there wasn't enough money to fund the transition. So what has happened in between? How did we get from a world with too much finance, too much money, too much debt, to the world of Mark Carney and others, the net zero coalition that gathered in Glasgow, BlackRock and so on, who said there isn't enough money and we are going to provide it, and that will be the breakthrough, the watershed that will fund the transition. I'm really puzzled by this. I mean, which research have I missed to show that we are now in a world where we need more finance for sustainability? Surely if there's too much finance for economic growth, is there too little finance for sustainable economic growth? Can you see the question? That's what motivates me these years. It's a very encompassing question, of course. To understand this, first we need to understand the frame, the common understanding of how investment and finance relate. Finance and investment and economic growth. So the textbook economics way of thinking about these concepts and linking them together in a theoretical story is to say that non-consumed income, whatever income we have, we don't consume, the rest is what we save. And those savings are equal to investments, because if you consume something, what's left over is apparently a capital good, which is left over after, let's say, 1 year of producing. And those investments, those are capital goods, productive capital goods, they're available to expand the economy in the end. How does this happen? Well, investment, capital good investment, needs to be financed by retained profit and external finance. So from the firm perspective, the firm can either pay for capital goods by their own profit, which they retain, meaning they don't pay out the dividends, or they can borrow, or they can raise equity. So borrowing and equity, the two forms of finance for corporate firms. And that's the expansion in assets and liabilities. So this is saving and this is finance. This is the finance that moves, transforms saving into capital goods investment. Careful when I use the word investment. We often use the word investment as for buying shares or bonds. That's not investment for a macroeconomist. Investment is creating productive capital goods like machines and robots. So I try to use the word investment exclusively in this sense. And then once we have investment, so this is assets and liabilities, that's money, and then firms can buy new capital goods or create it themselves. You have an expansion of the capital good stock K, which is investment, which transforms into income through a production function. Okay, you still with me? This is basic economics. So growth of investment, which is the change in saving, growth investment, change in saving, which should be proportional to the change in assets and liabilities, leads to an expansion or to an increase in capital good growth, an expansion of investment, which leads to an acceleration of GDP growth. Okay? That's summarizing what I said here. And here we're in the positive part of that graph that I just showed, where more bank credit, for instance, assets and liabilities, lead to more investment, lead to more GDP growth. Yes, please. And this is not something that you only learn in high school or first year of university, or which was taught 50 years ago but no longer. In a Nobel Prize that was handed out 2 years ago, the so-called Nobel Prize for Economics. This is the picture that they show to explain to the wider public why this Nobel Prize was given, where we savers, citizens, bring our money, our savings, and the bank and other financial intermediaries put that in some wheel called maturity transformation, and it ends up having real effects, windmills and solar panels and other more traditional economic activity. So this is not a misrepresentation of how economists mainstream think about finance and investment. Yes, please. However, so here comes the puzzle to me. In a McKinsey report last year, for instance, it was shown that financial assets and liabilities grew 50% faster than GDP since 2000, vastly exceeding net investment. Okay, so it's not true that all assets and liabilities in some way are linked to real capital good investment leading to GDP, because both grow much more slowly. I mean, 50% in only 20 years. That's a lot. So there is this financial slippage. Yes, please. You should make notes and and work the laptop. Another piece of research by the IMF shows that, again, from 2000 till 2020, total debt was rising from about 200 to 250, so a quarter again of debt relative to GDP, not debt in dollars or trillions of dollars, but debt relative to GDP. So this is how much faster it grows than GDP. Now, if debt grows faster than GDP, but debt is at the same time supposed to produce GDP, to help increase the income proportionally. If that was the case, debt and GDP, the ratio would be flat, right? Or maybe gently, right? But not something like this. And it's not something that's happened only since 2000. This goes back to the 70s. Yes, please. And finally, not only debt, not only general assets, liabilities, but also more specifically equity. Again, since the 1970s, since 2000, we can see there's been a steep rise in equity, again, relative to GDP. This is from Our World in Data. So, yes, please. So all kinds of finance we look at grow faster than GDP, grow faster than investment. In fact, there has been, since then, this is 1980, this is since the 1990s, there has been a slowdown in investment, which in itself is a major topic of research among macroeconomists. Why is investment so low in the developed world, especially, in the rich countries especially? So we see an increase in finance, and you would expect theoretically, therefore, an increase in investment. And this is, in the US, to be sure, private non-residential fixed investment. So it's fixed investment, it's in structures, buildings, and machinery. It's non-residential, it's not in housing. We're not talking about a housing slowdown here. It's really productive investment. And it's slowing down. At least the rate of the part of the GDP that is, yes please, that is devoted to investment is slowing down. That's true, as I said, for structures, for equipment. Equipment is actually rising quite a bit, but not, since 2000. Oh, this only goes from 2007. So it's gone down and gone up again, but it's not risen a lot. Something that has risen consistently, but not nearly as much as assets and liabilities, not nearly as much, is intellectual property, IP investments, intellectual property, so patents and so on. But there's also, that's another big debate among macroeconomists. What are we looking at when we say intellectual property investment? Is it genuine knowledge creation? Is it balance sheet expansion? Is it just valuation of titles? That's a very difficult issue. In any case, fixed investment isn't growing proportionally with assets and liabilities. Yes, please. So if that's the macro picture, then what if we zoom in at actual transactions of firms issuing bonds, creating more debt? Do they actually produce in a different way? Because you might say, well, you're focused on fixed investment or investment, but what really matters is what firms do in the end, right? So let's, yes please, let's look at this in a paper that I did together with Chris, where we, this was his research master thesis project. The paper is available, send me an email if you want all the details. We looked at the green bond market and we analyzed 147 corporates over 10 years. If I could have the next slide. So green bonds are bonds. A bond is a debt liability. It's an IOU that the corporate firm issues in order, in return for money. And so the money can be used for investment or other things. And these are green bonds because they are issued to fund projects that have positive environmental and or climate benefits, according to the Climate Bond Industry Association. The green bond market has grown outrageously fast since its 2007 inception to 1 billion in 2008, in the end to 3 trillion last year, but still that's only 2% of the total bond market. So all the debt liabilities is still 98% of everything, but still it's grown from a low base very, very rapidly. It's issued not just by firms, corporations, but also by municipalities, by sovereigns, so by different forms of government and supranational entities. So far, there is no evidence that there is a premium, meaning so far there's no evidence that green bonds are taken up for lower yields, so that the firms or the governments who issue them need to pay less to finance that debt. If that was the case, that would be evidence of a preference for the investors for debt. But we don't see that, which is quite remarkable in a world where everybody wants to be sustainable. And if we go to the next one, how do we know it's green? Well, it's subject to green bond principles, which are enforced or defined in a myriad of ways. There's 8 or 9 major raters, which are busy rating bonds as green bonds. Here are some of the principles, the green bond principles, which say something about the proceeds, which are focused on the financial instruments and the themes, the areas in which the green bonds can be used. If you want to know more about this, you can spend a lifetime. Let's go to the next slide. there's a very intricate taxonomy and description of what makes a bond a green bond. A lot of research in economics is focused on pricing, but there's little or no systematic analysis of real impacts. And the research that we have has mixed results. So the good news is that a very well-known paper by Caroline Flummer in 2020 found that corporate issuers improved their, improved their environmental performance post-issuance. And also Fatica and Panziga a year later published a paper where they say that green issuers display lower carbon intensity of their asset post-borrowing than non-green issuers. And they excluded refinancing green bonds because that's a complication. Often bonds are issued and the money is used to pay off bank loans or pay off other debt. Then how are you going to see the effect on the real production process? But on the other side, this paper by Lama Burglar that actually Lydia drew my attention to, which is very recent, finds that only a handful of green bonds in our sample, only 2% of the proceeds of the money that's raised with this for both corporate and municipal issuers fund a project whose green aspects appear generally novel for the issuer. So they very carefully, that's really monk's work, as we say in Dutch, it's really very careful work. They link the money that is raised by the green bonds to the projects that are funded by it. And they not only look at is it something that could qualify as green, but also is it something that is new, that wouldn't have happened otherwise. Well, in 98% of the cases not. So that's quite, and other papers by Tucano, Vulturius and Ehlers find the same thing, they find no effect. Yes, please. In our case,
Should I skip one?
yeah, this one. In our case, we collect data of 147 corporates in different sectors, different countries over 10 years. And we observe whether they issue a bond, or whether it's a green bond, yes or no. So we have, in the end, 224 observations of firms in a specific year making a bond issuance. We match green bond issuers to other firms which are very similar, and then we look at the difference between these two similar firms. This is called matching in order to make causal claims about what you're finding in terms of the statistics. And so they're matched on the size of the firm, the year in which the issue takes place, the region, the industry, Tobin's Q, which is the market valuation relative to book value, the return on average, return on assets, leverage, and the ESG rating. They're very similar firms, and we say, does a green bond issuer behave differently post-issuance than a non-green bond issuer? Okay, that's the methodology. Upfront the limitations, we only look at corporates, not at sovereigns or municipalities. We can't link, importantly, we can't link money to projects. We only can link money to firm outcomes, as you will see. The strong parts of the research are that we match firms, that we do this internationally. It's not just on the US market. A lot of the research is on the US only because it's such a big market. We look at different sectors and we look at physical outcome measures, not other measures. We look at the things that ultimately matter, such as carbon emissions. This is our sample. You can see that most of the observations are concentrated in 2017 and afterwards. Well, a lot of the observations are. This is when the green bond market develops really rapidly. We are spread out across sectors. You can see the property sector, utilities, industrials, and financials are important sectors. And here you can already see some problems. How would a financial issue with bond, how would that affect? Well, supposedly they are going to finance, again, non-financial companies in productive processes. And you see a regional distribution heavily skewed towards Europe and North America. Particularly, of course, this is where most of the corporates are. Yes. This is the analysis we do. I'm flying you through it, and you can read the paper at your leisure, of course. We try to link the outcome, which is carbon emissions or energy consumption per assets or per revenue, scaled in different ways, to the issuing of a green bond 1 or 2 years ago. And we control for firm characteristics, sector characteristics, and year effects. And so this is the differential between the two matched firms. And the outcome Thank you. I'm not going to show you the regression tables, but I'll give you the key outcomes, is that we don't find that firms financed by green bonds show cleaner production or less energy use. So both energy use per revenues or per asset and cleaner production, carbon emission per revenues or per asset, we find no difference. So we find no evidence, right? We don't find evidence against, but we can't find evidence. Neither by the firm itself, nor with regard to the energy that the firm buys for its own production process or in the total value chain, of course, but that's very hard. We do some additional analyses. In the interest of time, I'm not going to talk you through them. We find some entry points for more effective green bond practices because there are some industry differences. I think that's the most constructive or positive part of the paper. Yes, please. But overall, we don't find any evidence, okay? And there's some good reasons why you would think, well, it's really quite hard to find evidence in the green bond market because it's such an indirect way of financing, you might say. On the other end, it's the deepest, most liquid green finance market at the moment. So on that score, you would say if you would find an effect anywhere, it would be here. The jury is still out. But yes, please. We just add to the mixed evidence. Which brings me to my last bit of the presentation, and you will keep me to my time, right? So several other papers find this as well. And so most famously, I think the best paper is the one by Werger and Lam, which I just quoted. And all of these papers actually then go on in one of two directions, either to say, it's just a lot of greenwashing, right? Didn't we think it? These firms are just saying, they're going to behave better, and they just don't. They just finance whatever they were already doing. And maybe that's true. Maybe that's true. And the other more constructive thing to do is to say, well, okay, so it doesn't work perfectly. Apparently, we need better taxonomies, better rules for green bonds, etc., etc. I think that's the road to bedlam. I think it's really, really hard to read these taxonomies and so it's becoming more and more information intensive to understand what a green bond or what sustainable finance is, and it's probably not going to help much if you impose stronger or bigger regulatory burdens on firms who issue green finance to report everything and to create paper trails for everything. 5 minutes, okay. 10 minutes. Oh, 10. Oh, right.
5 would be better, but...
No, so what we'll do, if we go to the next slide, so explaining these micro-level findings, micro because it's really at a low level of aggregation, not just firms, but transactions, bond issues. We're trying to explain the effect of bond issues. We're not going to try to understand that and interpret that at the same level where we find it, but we go to the higher level at the system level. And I'm returning to my introduction. The system in which green bond finance is injected, so to speak, is a system where assets and liabilities have been growing faster, 50% faster than any real thing that we could expect from assets and liabilities, GDP growth or investment. So again, what is the reason for us to expect that green bonds have any different effects, right? So in a sense, it's unsurprising, even though it's also a bit disheartening. But if we can understand how this works, how this system works, maybe that's a better entry point to making sustainable progress with or without sustainable finance, right? No. So I'm returning to this textbook way of understanding the impact of finance on investment on real outcomes, which are measured in the capital goods stock and in GDP growth. That's a monetary measure, to be sure, but that's the realist that macroeconomists get. Assumptions that are applied in this view, this textbook view, is in the first place, or most importantly, that savers' money is a bottleneck for investment. That's just what Mark Carney said, right? Savers' money is a bottleneck for investment. And in particular, in our case, in the green bond market case, or in general in the securities markets case, securities are shares and bonds and other forms of finance for firms, but those are the two most important ones. In the primary securities markets, meaning at the point where securities, shares or bonds are issued, are given out by firms and the money is actually collected by firms, in the primary securities markets, we believe that they are a channel for savers' money which flows to non-financial firms who can now invest. That's to say that savers' money is a bottleneck for investments. But by far most of the investment, I'm using the word investment here, I shouldn't. By far most of the buying of securities by your pension fund, for instance, which they call investment in the financial markets, is in the secondary markets. It's investing in already existing bonds or in an index fund that tracks bonds. And the idea there is that this will decrease yield, so it will make it cheaper for firms to finance themselves, or increase the price of shares, again, making it cheaper for firms to finance themselves through equity, and that leads to more productive investment, okay? So whether in the primary or the secondary security markets, this is how saving money that is saved is supposed to release investment. Yes, please. But we know that's not true. Yes, you should already be shaking your head now, because the graph that I shown before already showed you that a lot of this money that goes into assets and liabilities actually makes assets and liabilities grow, but doesn't have the result that investment or the capital goods stock grows proportionally. This is another paper we're working with other co-authors on the UK economy since 1995. The green bars is the sum total of all the assets in this data set, which is a national macroeconomic data set from the system of national accounts. Shares, other equity, debt securities and loans. And you can see that in nominal, I think in billions of pounds here, in nominal terms, this grows from 5,000 to 30,000, so a six-fold increase from the mid-90s until the great financial crisis, and then it stabilizes. A six-fold increase. And you can see that the produced non-financial assets, as statisticians say, that excludes lands, which is non-produced non-financial asset. So this is machines and robots and so on, and structures, buildings. We can see that roughly doubles in nominal value terms. Yeah, so again, we see this growing 3 times faster than what it is supposed to finance. Okay? So this correspondence between assets and liabilities and the capital stock isn't there, and therefore this correspondence between assets and liabilities and the ultimate outcome, which is GDP for macroeconomists, which is sustainability for us, also is not there. Okay, this is just the same, yes please, just the same as what I showed in the beginning, but on a more concrete level, looking at the actual capital stock. So let me briefly present an alternative way of looking at the links between finance, investment, and outcomes. And I'm almost ashamed to do that in such a learned company. This is really laying out very basic insights in what is called post-Keynesian economics, or more generally heterodox economics, building on people like Marx, Keynes, Kalecki, Schumpeter, and the so-called circuit theorist, Graziani, Schmidt, Pargas, and also Minsky, the American post-Keynesian economist, and contemporary people working in this tradition, some of them in this room. And a fundamental starting point here is the economy is both a monetary production economy, meaning production economy, that's clear, it's a system that gives us all these gadgets and well-being and long lives and health, but it's a monetary production economy. So everything's expressed in money. And because everything's expressed in money, also everything needs to finance. Everything needs to be transacted in money, and so it needs to be financed. And therefore, we have the flow of the economy, the circle of the economy, going from production to consumption and so on, but we also have a financial circle of flow. We can conceptualize the economic system as 2 flows, which should be like wheels that are meshing and that are supporting each other, but as I said in my introduction, often they are not. Second, financial investment, meaning the creation of gross assets and liabilities, gross meaning the total amount of them, not netting them out, of the non-financial sector, financial investments lead to autonomous and self-reinforcing expansion of the financial circulation of this mass of assets and liabilities, but not necessarily to capital goods investment. That's another basic post-Keynesian insight. And this was consensus during the great financial crisis, I should say. It was then clear that there were a lot of financial investments in mortgage-backed securities and so on that did not lead to capital goods investment or to more economic growth. And finally, it's also an understanding here that corporate investment, which we're specifically looking at the green bonds example, and which is most of the investment going on in the world anyway, corporate investment is mostly from retained profit and inter-corporate capital markets, meaning corporates, non-financial and financial corporates, lending to each other. Credit clubs, in the words of Michael Kalecki. So if I were to create a picture, so here in the corner you can see the picture from the Swedish Nobel Prize committee. My picture to rival that or to replace that would be to say, yes, here's the real economy. From production and sales, you get profit and wages, so there's distribution between workers and capitalists, as they say, distribution to profits and wages. What is not consumed of this is saved, there should be an arrow the other way, is saved, and from the savings you can get real investment. That's the story. What actually happens is the savings are financial savings. They're not real investments. You don't save machines, you save money. And so the money is a financial investment. Your bank account is a financial investment. You can buy shares. That's a financial investment, or bonds. And that drives up asset prices and returns. And that is a financial expansion. So this is the expansion of assets and liabilities that we see. They should be proportional to the real investment, because through liquidity creation and distribution by banks amongst others, also in repo markets, we see financial expansion and then real investment. Okay, I'm talking you through this very quickly, but still the idea is money goes out here and comes back in here, so we might as well say it goes from here to here. That's what macroeconomists do. That's what the simple macroeconomic models and textbooks tell you, and it's a good simplification. Models need to be simple if it's true. The problem is this red arrow, of course. So this is financial deepening. This is the financial sector supporting the real sector. This is what we call financialization, which is a word that is thought up to talk about the dark sides of financial development or financial expansion, saying that, well, the financial expansion could go into, let's say, mortgage products, as we learned in the financial crisis. That leads to more financial investment and more asset price rises and more capital gains. And the people who are in here get very rich, but it doesn't have much to do with the real economy. Okay, that's the standard understanding and explanation of the great financial crisis. And basically, the global financial system hasn't suddenly changed since then. It hasn't changed all that much since we started talking about sustainable finance. So why do we think that sustainable finance in this environment works very different? That's what still puzzles me. Yes, please. Yeah. So how does this reflect on the assumptions that are applied in the standard story? Well, savers' money is not a bottleneck for investment if there's money circulating in this financial circuit. And in this financial circle, a lot of the non-financial corporate companies are also operating. It's called shadow banking nowadays. It's what Kalecki decades ago called a credit club. It's the same thing. It's non-corporates creating liquidity and lending and borrowing to and from each other, which is going on all the time. And they don't need the real sector to validate that in terms of real capital goods. And it's also not true that the security markets bring money from savers to capital goods, because this savers' money is not needed to finance the financial investments which the financial circuit is all about. And there's no necessary link. There might be a link, but there's no necessary link with real capital goods expansion or innovation. Very quickly, in my last few minutes, we then started to explore. This is where the project now is. This is the next paper, so I'm trying to squeeze 3 in 1. In this this sample of global corporates, the same sample that we did the green bond analysis on. We created a balanced sample to make sure it's not distorted over time. And over time, you can see that profit, before taxes and everything, is always much bigger than capital expenditures. So the so-called external finance need, how much money does the corporates in aggregate? How much do they need to borrow in order to realize their capital expenditures, capex? Well, nothing, actually negative. Now this is before buybacks and dividends and so on. So we need to gather that information as well, and then you can have the retained profit, but still I'm pretty confident there is enough money in the corporate world to make the sustainable investments. So it's not reasonable, not rational to expect that adding more money to it is going to increase sustainable investment in some way. And within this sample, we see the same pattern that I showed on the macro and even on the global level, namely that capital expenditures, which is investment in the actual productive capital stock, is not rising proportionally with the expenditures in all liabilities or even in net debt, which is debt minus assets. Okay. So again, we see the same on the corporate level, on the firm level, as we see on the global level. So that sort of vindicates, or that is in line with this second vision of how the economy works. Where does that leave us? And I think I want to skip to the next and the next slide. So in the interest of time, we can go back to those slides. Those slides were concrete ideas of how can we strengthen this link between finance and investment, okay? But basically this picture that we created is, so this is the work together with Hans Tegeman of Triodos Bank. This picture is, I think, a useful way to start thinking about which forms of finance are more helpful for investment than other forms. We need to align the control over financial expansion, the creation of assets and liabilities on the vertical axis, to the control over investments in sustainability here. For instance, SMEs have a lot of control over investments. They do the investments themselves, but they have almost zero control over the expansion of finance because they're not in the big financial markets. Whereas non-financial corporate firms, some of them shadow banks, the asset managers like BlackRock, Vanguard, State Street, institutional investors like your pension funds, and banks which operate in these financial markets, they have big control over the expansion of finance, but they have almost zero control over the expansion of investment in sustainability, right? They are not, in the words of Benjamin Brown, who wrote a paper on asset manager capitalism, they are not economically invested agents. They are financially invested agents. They often don't even know, that's certainly true for your pension fund, a lot of the money that they invest, they don't even know where it goes because they give it to asset managers to manage, right? Some of it they invest more directly. But the idea is to be as much as you can in this corner. And here we find, for instance, the fiscal authorities, so governments that spend typically know much more directly what they are financing, or off-balance sheet fiscal agencies. Stefan Murrow in Berlin is doing great research about this. Small-scale banking is there. Smaller non-financial corporations are probably there as well. The question is, and I think if you go, in conclusion, go back one slide, if you want to go back one slide. Yeah, thank you. Since I'm here in the IIPP, I need to mention this as well. So remember, here was the government, right, in the right upper corner. My plea here is not to say the sustainability, the whole sustainability transition needs to be financed by governments or by supranational entities. It's probably necessary to draw in private capital as well and private agents as well. The question is how you do it. The question is how do you do that? In this corner, remember, is where financial expansion and investment are actually aligned, where there are agents, namely states, who have control over both, controlling state spending and controlling where that spending is going. Okay, and if they take the lead, they might actually draw in some of the guys here who maybe don't have control over investment, but they do have control over the expansion of finance. And if they get the incentives, for instance, by governments creating mission-oriented policies, market shaping, not market fixing, the whole work that Mazzucato and others have been developing. That might be the basis on which the financial agents, who are not really invested in the real economy, behave as if they were. Well, I probably need to stop here. Thank you very much.
Questions? Okay. Start here. If you could just say your name and where you've come from today.
Yeah. Thank you. I'm not sure if this is working.
Oh, it's just, sorry, it's just for the camera.
Okay,
It's not,
nice.
It's not going to amplify your voice. Speak louder.
Thanks. Hi, that was really interesting. Thank you. My name's Ryan. I work in sustainability consultancy. We work with a lot of corporates actually to do decarbonisation of their real estate assets. So a couple of observations I had and maybe a question to start with actually is, through working with corporates, we've found that the majority of their emissions are often in scope 3, maybe 95%. And also the vast majority of corporates are currently measuring that on a spend basis. So they're using very simple emissions categories and categorising their spend into those categories to estimate the scope 3. And therefore, if they make a purchasing decision or an investment in sustainability that affects their value chain, they won't necessarily see that in their emissions accounting. So, you know, have you thought about that? And do you think there's any way you can account for that in your analysis?
Are you specifically talking about scope 3?
Specifically, yeah, and I do have a comment on scope 1 and 2 as well.
Yeah. Yeah, that should be, I mean, that should be in the data that we used.
So in, I guess, so when you're correlating the increase in green finance, for example, for a corporate compared to another corporate, and you're perhaps seeing that there's no change in their scope 3 relevant to that increase in green finance, how do you actually verify that if corporates aren't able to actually demonstrate a reduction in scope 3, then
So they could be
struggle to make that link.
Yeah. So I think it's all self-reported, isn't it? Yeah. So if the self-reported scope 1, 2, and 3 emissions, so that's the data that we take.
Yeah.
And then we don't see a difference. Yeah.
So we don't.
That's all I can say.
Yeah, no, absolutely. Because I guess the problem is that there's a lack of data on how that green bond's being used. So that could be a limiting factor to conducting that analysis at the moment. And I think it works the opposite way as well, because banks can't demonstrate that their finance is having an impact a lot of the time because the data's not really there, and therefore there's less of an incentive to provide more green finance, possibly.
That's an open question to me. But I mean, banks just as bond issuers, if they have an obligation or an incentive to set up administrative systems to be able to report emissions, they should be able to do that to an extent. But I will finish. I'm hesitant to say that. So they should do it better, for the reasons explained in the seminar. I'm not sure that even if they did much better, given the nature of the financial system in which there is abundant liquidity anyway, I can't see that it's going to make a large-scale difference. Of course, individually it may. But I want to talk more about that.
Half an hour after 5:30, so you've got plenty of time.
Yeah.
Any other questions? Start here and then we'll go to the back to Ruben. And then
Thank you. Jens Dafermos from SOAS. Thank you so much. Lots of things to think about. Maybe just two thoughts. So a quick one on your results. I mean, in my view, what you got is not surprising. In what sense? You have, let's say, a big company that has very carbon-intensive production, and then they issue 1 or 2, 3 green bonds. And even if they are successful, if they really use them in order to reduce their carbon emissions, this will be a very small part of their overall emissions. So I think it makes more sense to focus on companies that perhaps have issued a lot of green bonds and then they don't deliver, instead of just saying that we don't see something related to emissions. And related to that, the argument that has been made about green bonds is that we should evaluate both the projects and the overall performance of companies at the same time. and not to. So we need to make a distinction between green bonds related to very carbon-intensive companies that don't have any plan to improve, and companies perhaps that make some progress in terms of reducing their overall emissions. So, I mean, it doesn't change your argument, but I think it's important to make that clear, because in principle, there can be cases whereby you can see some improvements if you are strict in terms of how you evaluate companies. Now, on the broader issue that you raised, I agree, of course, about the argument that within this environment of financialization, it's very difficult to have actually finance for productive green investments. I think there is another issue on the fact that there's still a lot of dirty finance. And if you think about a company, even a big one that has a lot of profits and they don't need to rely so much on finance, at the end of the day, they care if they get access to loans at low interest rates, if they have high bond prices, if they have high stock prices. So from that perspective, they care about finance. But this, in my view, introduces the issue of how to penalize companies that do not make progress. And one issue with green bonds is that in principle, they try to provide a kind of a carrot, but where is the stick? For those companies that have dirty finance, they can continue business as usual. I mean, we still have a lot of real investment in coal and gas, and nobody does something about this. So I think the other issue is what kind of finance, not from a productive perspective only, but also from a carbon-intensive perspective, and how we can change this by penalizing this type of finance in these big companies that actually are so powerful.
Yeah.
Thank you.
Yeah, very, very briefly, the first concern that only 2% of all bonds is green bonds, so you're going to find a statistical effect anyway. So the paper by Lem and Worgler looks at the project level, so there you should see an effect if you can link money to actual projects. So that's a better paper than what we did, to be frank. And your last remark is very well taken. So finance is all about positive, about incentives, as they say, about carrots and positive change. But where's the stick? Yeah, that maybe the stick is more effective. Yeah.
Hi, thank you for that really interesting talk. My name's Ruben. I'm a PhD student here at IIPP. So my question is, how do you see the changing financial architecture geopolitically with the BRICS and the sort of the BRICS Bank and the sort of alternative system of finance that's starting to emerge? How do you see this sort of influencing the current sort of financial system in the G7 and things like the green bond markets and the power of these big financial institutions. So yeah, it's just a question how you see these sort of geopolitical developments interacting with these questions of the green transition within the quote unquote West.
Yeah.
Maybe pass to the colleague behind you as well, and then
Yeah, I'll try to be brief in answering this vast question again. So this is not about international climate finance. That's a whole different kettle of fish. There comes into play the question of the savings gap. Do so-called emerging economies, they're never sinking, always emerging economies, do they really need the liquidity in some sense from let's say from the big merchant banks or from the big debt buyers to realize? And in a sense, we've seen this in the development story when China started becoming active in, for instance, Africa, in providing finance for very concrete things like mines and railways and so on. So then suddenly it was possible to let finance work for economic development, which, for instance, the World Bank had been saying it was doing, but hadn't done it nearly as effectively as China. So the geopolitical change and the aims of the geopolitical actors clearly matter to how the finance is used. That's a very important observation in this regard, I would say, but that's not even the start of an answer, I suppose. But it's a very big issue. Yeah.
We've got one person behind Ruben and then Katie,
Hi. This is Kevin. I work in a nonprofit think tank researching primarily sustainable bond markets, and I also a part-time student here at UCL. My questions is on the green bond projects that you were presenting. I was wondering if you have any different results if we are looking at a regional or sectorial level. I know the sample size may be a constraint, but I would just on top of my mind is the European utility sectors. I thought I think it's quite straightforward in the sense that a lot of utilities are large ones has issued green bonds that you may not actually find a very similar matching a twin per se, and at the same time the renewable capacity that they build by these utilities are very much also funded by green bonds. And I think Ørsted is the example that I have in mind, that it has transitioned itself from a fossil fuel companies to the largest green power companies, and it actually has quite a majority of their debt profile. It's through the labeled bond market. So I'm just wondering what's your take on that? And my second part of the question is that I think you said that's still quite a small 2% of the overall debt markets. Are you optimistic that if the green financing scale up in a credible way, it can actually have some impact?
So to the first, so the difficulty here is, or I should say the limitation of this kind of academic research is that it's trying to come with one coefficient reflecting the experience of, in this case, 147 corporates over 10 years in different continents and sectors. So there's a lot of heterogeneity, a lot of different experiences under that one number that I report, and some of the experiences what you're talking about. But still, on this aggregate level, we do see some differences between sectors. So, for instance, in finance, the property sector, and consumer cyclicals, washing machines, and so on. Those sectors are apparently least sensitive to green bonds in terms of changing their emissions. And for financials and real estate, I think that is obvious. So yeah, I take your comment as saying, well, there are sectoral differences, and it works well here, but doesn't work well there. And so more fine-grained work, also research work, may actually uncover more where finance can make a difference, where it doesn't. So also I'm talking about corporates all the time. For SMEs, small and medium-sized enterprises, surely the story must be very different, because they're much more dependent on finance, so that directing finance immediately is much more of a stick, and not just a carrot, because they really cannot do without that. And on your second question, let's say that the green bond market goes from 2 to 20%. Would it be good? On the present evidence, we don't know. We don't know. Some papers find effects, other papers find no effects. So we simply don't know. Which is exactly what you would expect, by the way. If there is no true effect, if the effects are random, then you pick different samples like these different researchers do. Some will find maybe effects and some won't. So far there is no evidence to say that green bonds lead to greener production. But with all the limitation to that research that there is, of course. It's not set in stone, of course.
Then we've got Katie. I think we started a little bit late and we've got the room, so we can maybe run for another 10 minutes, but if you've got meetings to go to. And then we've got another question here as well after Katie. But yeah, if you need to go, feel free to head.
Yeah, thanks for a great presentation, Dirk. I really enjoyed it. I was really taken by your quadrant that you had at the end with the, what was it? Yeah, this one. Yeah, expansion of finance and then expansion of investments in sustainability. It strikes me that bottom left corner in particular, the kind of the real economy actors who we really need to undertake fixed investments for the green transition, the story there isn't so much, there is a supply of finance issue, but I think what is also not discussed is the demand side, and the fact that, for SMEs in particular, there's huge risk to undertake, that they have to undertake in order to, retrofit their buildings, or in the case of the agri-food system, like farmers have, very little kind of cash available to invest for transition, stuff like that. So I think that's a kind of a missing part of the story here that you could perhaps bring in into your conclusions. It's not just about credit guidance to direct the finance, it's also, okay, de-risking, I guess, on the demand side as well to kind of stimulate that investment.
How do you think about the counter-argument to this, to say that, you know, but most of the investment is done in the corporate world. You know, there's a lot of SMEs, a lot of employment, but most of the investment is actually done in the corporate world.
Care to respond? No. Go ahead.
Hi, I'm David Bent. I'm an honorary lecturer in the Institute of Sustainable Resources. I was also a non-executive director of Vigeo Iris, which was one of the ESG bond raters that you had on one of your earlier slides. So lucky me, I saw some of this firsthand. I guess, so there's two things. So firstly, in the top right corner, I wonder if family offices could be players who have much more control over their direct investments as well as control over the expansion of finance. And that's where a lot of change agents in the sustainable finance world are looking at, because they may have more control and less regulated than institutional investors. Mm-hmm. And I guess the second thing is, for the Minskys and the Carlota Perez's of this world, when it comes to the shift from bubble finance into actual diffusion, that happens after a crisis. We've had the crisis, and it ain't changed. So what can we realistically do to move away from over-financialization, given that the historic mechanism that we've relied on hasn't worked in the last 10 years?
I don't know. I mean, when you look at just after the financial, typically, well, there's two ways to answer. The first is what you refer to Carlota Perez work, which sort of sketches a sort of law-like development. This is how it works. You know, you get diffusion after the crisis. Maybe it has happened. I mean, the whole boom in sustainable finance investment has happened after the recession of the great financial crisis. That's one. But the other way it happens is if policymakers are so desperate about the situation that they really rein in banks, you know, big banks and big governments, as Minsky says, come in and they refix, and you get to the next stage of the financial supercycle, as your work shows. And so in 2009, Obama had the banks by the balls. He was bailing them out, you know, trash for cash for trash, rather. But he didn't really use his power to rein them in. And so, yeah, if there's no political willingness, it's not happening. That's the other way to look at it. I don't know.
Yeah, thank you for the great presentation. I'm Antonius, a PhD student at the UCL, at the Barrett School of Sustainable Construction. So my question is, do you believe on the green growth? Because like lots of discussion in London, like GDP is not really relevant if we talk about the environment, and also like what's your opinion on that? And the other thing, look at your research. What do you think about the role of the time span? Like there is a Paris Agreement in the mid of your research. Then also the nature of this kind of low carbon technology investment. That I'm an engineer by degree, so it's kind of like a take 5-10 years, like a hydrogen, etc. So it's really take lag time to like a really. There is no low hanging fruit. Like it's like a high hanging fruit. That so yeah. So to bring the optimism to the table. Thank you very much.
Yeah. Yeah, so both points really well taken. So one of the limitations I should have mentioned much more powerfully or at all is that we look at, in this research, we look at 1 and 2 year lags of the green bonds issue to the outcome, which every engineer knows is ludicrous. But that's how young the green bond market is. There isn't, you can't, you know, if you start looking for longer lags, number of observations drops rapidly. You can't do any statistical analysis. So yeah, maybe we should just wait, and it's still coming, but that's a statement of faith, not of research so far. It's still too early to know, like the French Revolution. Yeah, yeah, thank you.
And the green growth?
And green growth. So Jason Hickel was in the Netherlands a while ago, and then everybody was decrying degrowth. I think it was a really stupid title, degrowth, to be honest, because as I read him, his his point is we should grow the good things and shrink the bad things, if I put it simplistically. If that turns out to be degrowth, you know, so be it. But that's not the point. And we will always need finance to reallocate factors of production, as economists say. So whether or not you believe in green growth, yes or no, I think that doesn't change this question very much. But yes, I believe in green growth of green activities, and I believe in green shrinkage of dirty activities. Make sense?
For one. Oh yeah.
Additional. Sorry. So, like, you use like a GDP increase also in your
whether or not
metrics.
whether or not the net GDP change is positive or negative is completely irrelevant.
You're
to me.
okay.
I'm okay with
Okay.
with negative or positive change. Yes. Yeah.
Okay. Thank you
Yeah.
so much. Thank you.
Maybe one more. Excellent.
Thank you so much. I've learned so much. Is one of the issues that also, where we've just been talking, there isn't really any proper roadmap for either CapEx or OpEx expenditure, which fuels any realistic transition. That, you know, you haven't got the financialization for either of them in place.
But isn't that too I mean, shouldn't firms themselves make that roadmap in the course of their corporate planning?
Doesn't there need to be a sort of at a national level a roadmap that is supported by government policy, by international financial institutions and their kind of policy objectives?
That's an open question to me, but
Okay.
if there is to be, the question is at what level of granularity should it be? Should it really be at the level of how much is going to be invested where, even by which company or sector? I don't think governments know enough to really do that, even if they want to.
But while we have a sort of rentier kind of capitalist system where, as you say, the cycle that recycles the profits into investment is broken because everything is financialized and people buy back shares and all the rest of it. I mean, it's a naive question.
So then I think I see the role of regulators and maybe also governments, in this case regulators, to regulate buybacks, for instance, in your example.
Yes.
The question is how, but that's doable.
So I mean, these are much more sort of practical considerations than the ones that you
and then leave to firms to work out how they change their expenditures, given that they can't do buybacks anymore in this hypothetical world. Yeah.
So it's sort of policy issues. Thank you so much.
Yeah.
I think I'll probably wrap up the main discussion, but we've got the room, so if you want to chat to Dirk afterwards, that would be great. But yeah, any final words?
Thank you so much for all these excellent questions. I've been scribbling along and for forcing me to think hard about what this is all about. Thank you very much.
Yeah. Thanks everyone for coming.